Silver just had its worst day in 46 years. Not a bad day, not a rough day, the worst day since March 27, 1980, when the Hunt brothers' legendary attempt to corner the global silver market collapsed in catastrophic fashion and nearly brought down several major financial institutions with it. On January 30, 2026, silver futures plunged 31.4% in a single trading session. Gold dropped below $5,000 an ounce, shedding more than 10%. Mining stocks cratered. Exchange traded funds imploded. Retirement accounts holding precious metals were decimated in hours, and it all started with a name: Kevin Warsh. At 7:14 this morning Eastern Time, President Donald Trump posted a message on his Truth Social platform. He announced that he was nominating Kevin Warsh to be the next chair of the Federal Reserve. 12 sentences. That was all it took. Within minutes, silver began falling. Within hours, it was in free fall. By the time markets closed, the damage was measured in hundreds of billions of dollars. To understand how one appointment could cause this much destruction this fast, you need to understand what has been building in financial markets for the past 12 months. You need to understand the fear that drove precious metals to heights they had never reached. And you need to understand why that fear, which had seemed so rational just yesterday, suddenly evaporated this morning. This is that story. It begins with a conflict that has been simmering since Donald Trump's first term. A conflict between a president who believes he knows better than the experts and an institution designed specifically to resist political pressure. The Federal Reserve is not like other government agencies. It does not answer directly to the president. It is supposed to make decisions about interest rates and money supply based purely on economic data, insulated from the political pressures that would tempt any administration to print money or lower rates for short-term popularity at the expense of long-term stability. This independence is not a bureaucratic quirk. It is the foundation of the dollar's credibility. When investors around the world choose to hold dollars, when foreign governments choose to price oil in dollars, when international trade flows through the American financial system, they do so because they trust that the Federal Reserve will not debase the currency for political convenience. They trust that when the Fed says inflation is under control, it is telling the truth. They trust that monetary policy is being set by professionals, not politicians. When that trust is damaged, everything built on it becomes fragile. Donald Trump has been testing that trust since 2018. He appointed Jerome Powell as Fed chair during his first term, then almost immediately began attacking him for not cutting interest rates aggressively enough. By 2019, Trump was calling Powell an enemy of the people. By 2020, the attacks had become routine. When Trump lost the election and spent 4 years out of office, the assault paused. When he returned to the White House in January 2025, it resumed with renewed intensity. From his first week back in power, Trump made clear that he wanted rates cut dramatically. He believed high interest rates were strangling the economy, punishing homeowners with expensive mortgages, hurting businesses that needed to borrow, and undermining his economic agenda. Powell, following the Fed's mandate to maintain price stability, resisted. Inflation was elevated. The economy was running hot. Cutting too fast could reignite the price spiral that had caused so much pain in 2022 and 2023. This disagreement is not unusual. Presidents often want lower rates. Fed chairs often resist. What made this different was how Trump responded to resistance. He did not accept it. He weaponized every tool at his disposal. He called Powell a stubborn mule. He called him Mr. Too Late. He suggested Powell was deliberately keeping rates high to sabotage his presidency. He mused publicly about firing him, even though legal precedent suggested a president cannot remove a Fed chair simply for policy disagreements. Then, earlier this month, it escalated to a level that shocked even veteran observers of this conflict. The Justice Department served Jerome Powell with subpoenas as part of a criminal investigation. The official focus was testimony Powell had given before the Senate Banking Committee about a $2.5 billion renovation project at the Federal Reserve's Washington headquarters. Critics immediately identified this as pretext. The renovation had been underway for years, approved by previous administrations. There was no credible evidence of wrongdoing. Powell himself called out what was happening. He released a statement saying the threat of criminal charges was a consequence of the Federal Reserve setting interest rates based on its best assessment of what would serve the public rather than following the preferences of the president. Every living former Federal Reserve chair agreed. Alan Greenspan, Ben Bernanke, Janet Yellen. They all spoke publicly about the danger of what was unfolding. This was not normal policy disagreement. This was an attempt to intimidate the central bank into submission. Now imagine you are an investor watching this unfold. You see a president openly threatening the Fed chair with prison for not cutting rates. You see the Justice Department being used as a weapon against the leader of an independent institution. You ask yourself, if this is what Trump does to Powell, what will he demand from the next Fed chair? And if the next Fed chair simply does whatever Trump wants, cutting rates regardless of inflation, printing money to juice the economy before elections, what happens to the dollar? What happens to your savings? The answer investors reached was alarming. If the Fed loses its independence, the dollar loses its credibility. And when paper money loses credibility, the hedge is precious metals. Gold, which has been a store of value for 5,000 years. Silver, which has served as money since ancient civilizations. Assets that cannot be printed, cannot be debased, cannot be manipulated by politicians. That fear drove the most extraordinary rally in precious metals history. Consider the numbers. In 2025, gold rose 66%. An asset class that typically moves in single digit percentages gained two-thirds of its value in 12 months. Silver did even better. It climbed 135%. It more than doubled. By January 2026, the rally accelerated further. Gold touched $5,595 an ounce. Silver breached $121. Both were all-time records. Both were prices that would have seemed like fantasy just 2 years earlier. Hedge funds piled into the trade. Central banks around the world increased their gold reserves. China added to its holdings for 5 consecutive months. The fear of Fed politicization had become a global phenomenon, and the hedge against that fear was precious metals. But here is what happens when a trade becomes too crowded, when everyone rushes into the same asset, when prices rise too far, too fast, disconnected from any fundamental anchor. The correction, when it comes, is brutal. Analysts had been warning for weeks that precious metals were overheated. Prices had become stretched beyond any reasonable valuation. Gold at $5,500 was historically expensive relative to production costs, relative to jewelry demand, relative to industrial use. Silver at $120 was trading at multiples that rarely sustain. A pullback was inevitable. The only question was what would trigger it. This morning, they got their trigger, Kevin Warsh. To understand why this name reversed the rally, you need to understand who Warsh is and what his appointment signals. Kevin Warsh is 55 years old. He is currently a fellow at the Hoover Institution, a conservative think tank at Stanford University. He lectures at Stanford's Graduate School of Business. He moves in elite circles, counted among the most respected voices in monetary policy debates. But his credentials that matter most are older. From 2006 to 2011, Warsh served on the Federal Reserve's Board of Governors. He was appointed by George W. Tend, Bush at just 35 years old, making him the youngest Fed governor in American history. He arrived at the central bank as the housing bubble was still inflating, as subprime mortgages were still being packaged into securities that would soon become worthless. As the financial system was building toward catastrophe without knowing it, he was there when it all collapsed. He was there for the chaos of September 2008, when Lehman Brothers went bankrupt and the global financial system teetered on the edge of oblivion. He was there for the emergency rate cuts, the bailouts, the unprecedented interventions, the moments when policymakers genuinely did not know if they could prevent a second Great Depression. That experience shapes a person in ways that cannot be replicated by reading textbooks. Warsh knows what financial panic looks like from inside the room where decisions are made. He knows how quickly confidence can evaporate. He knows the weight of responsibility when your choices affect billions of people. During his time on the board, Warsh developed a specific reputation. He was known as a hawk. In the language of central banking, hawks and doves represent two poles of monetary policy philosophy. Doves prioritize economic growth and employment. They tend to favor lower interest rates, more stimulus, more accommodation. Hawks prioritize price stability and inflation control. They tend to favor higher interest rates, tighter policy, more caution about the risks of cheap money. Warsh was firmly in the hawk camp. During the years after the financial crisis, when unemployment remained near 10% and the Fed was engaged in massive quantitative easing, Warsh repeatedly warned about inflation risks. He pushed back against aggressive monetary stimulus. He argued for tighter policy even when his colleagues wanted to keep flooding the system with liquidity. At the time, his warnings did not materialize. Inflation remained subdued for years. Some critics said Warsh was wrong, but his intellectual framework remained consistent. He was not someone who believed in endlessly easy money. He was not someone who would reflexively cut rates at the first sign of trouble. Before the Fed, Warsh worked at Morgan Stanley, one of Wall Street's most prestigious investment banks. He spent nearly 7 years there, working in mergers and acquisitions, advising major corporations on their biggest transactions. He developed relationships across the financial industry. He learned how Wall Street thinks, how traders react, how markets function in practice rather than in theory. There is one more detail about Warsh that investors noted this morning. His father-in-law is Ronald Lauder, the heir to the Estee Lauder cosmetics fortune. Lauder is a billionaire, he is a longtime Republican donor, and he is one of Donald Trump's closest personal friends, someone who has known Trump for decades and maintained that relationship through every controversy. This connection could be interpreted two ways. It could mean Warsh is essentially a Trump insider who will do whatever the president demands. Or it could mean Warsh has independent wealth and social standing that give him freedom to push back without fearing for his career. Wall Street chose the second interpretation. They looked at Warsh's history, his hawkish record, his crisis experience, his Wall Street credibility. They concluded that while Warsh would certainly support rate cuts in the current environment, he would not be a mere puppet. He would not simply do whatever Trump tweeted. He would maintain at least some degree of the independence that makes the Federal Reserve credible. And in financial markets, when the worst case scenario becomes less likely, the trades built on that scenario unwind. They unwind fast. Let me describe what happened in markets today because the speed and scale were historic, the kind of move that traders who have been in this business for 40 years had never witnessed. Within an hour of Trump's announcement, silver was down 10%, not a gradual decline, a vertical drop. Within 2 hours, silver was down 20%. By midday, the selling had become so intense that exchanges around the world began emergency interventions. The Shanghai Gold Exchange raised margin requirements for silver contracts. Traders who could not post additional collateral were forced to liquidate their positions immediately. This forced selling created more selling. As cascading margin calls triggered a waterfall of liquidations, the CME in Chicago widened its daily price limits to accommodate the violent swings. Circuit breakers triggered. Trading systems strained under volumes that exceeded anything programmed into their capacity models. By the close of trading in New York, silver futures had settled at $78.53 per ounce, a decline of 31.4% in a single session. The last time silver fell this much in one day was March 27, 1980. That was the day the Hunt Brothers Corner collapsed. The Hunt Brothers saga is worth recounting because it provides historical context for what happened today. In the late 1970s, Nelson Bunker Hunt and William Herbert Hunt, heirs to a Texas oil fortune, decided to buy silver. A lot of silver. They started accumulating the metal in 1973 and kept buying through the end of the decade. By January 1980, they held an estimated 100 million ounces of silver directly, plus enormous positions in futures contracts. Their buying drove the price from around $6 an ounce to nearly $50, an eightfold increase. Then the exchanges changed the rules. The COMEX limited the number of contracts any single entity could hold. Margin requirements were raised dramatically. The Hunts could not post the collateral required to maintain their positions. They faced margin calls they could not meet. They began selling. When the largest buyers suddenly become sellers, prices collapse. Silver crashed from $50 to below $11 in 2 months. The Hunts lost billions. Banks that had lent them money faced massive losses. The entire financial system shuddered. What happened today was not caused by manipulation. It was caused by the unwinding of a legitimate fear trade. But the dynamics were similar. Prices that had risen too far too fast suddenly reversed. Leveraged positions that had seemed profitable became catastrophically underwater. Margin calls cascaded. Selling begat more selling. The magnitude of loss for real investors was staggering. If you had $10,000 in the iShares Silver Trust ETF yesterday, the most popular way for ordinary retail investors to gain exposure to silver prices, you woke up today with approximately $7,000. $3,000 gone, 30% of your position. In one trading session, if you were using leverage products, the destruction was worse. The ProShares Ultra Silver Fund, which is designed to deliver twice the daily return of silver, lost more than 60% of its value today. If you had $10,000 in that fund yesterday, you have less than $4,000 today. Some traders using even more aggressive leverage were wiped out entirely, their accounts liquidated by their brokers. Mining stocks were dragged into the carnage. Newmont Corporation, the world's largest gold mining company with operations spanning 6 continents, fell more than 10%. Barrick Mining, Agnico Eagle, Kerr Mining lost 17%. First Majestic Silver, Pan American Silver. Companies that employ tens of thousands of workers, that anchor communities in Nevada and Alaska and Canada and Australia, saw their market values decimated not because anything changed in their operations, but because the price of what they dig out of the ground fell off a cliff. Exchange-traded funds tied to precious metals had their worst days on record. The iShares Silver Trust lost 31%. SPDR Gold shares tumbled. Every fund designed to give investors exposure to these metals delivered the same message. Safe havens can become slaughterhouses when the narrative shifts. Analysts struggled to process what they were witnessing. Christopher Wong, a strategist at Overseas Chinese Banking Corporation, said the sell-off validates the cautionary tale of fast up, fast down. It was like one of those excuses markets were waiting for to unwind parabolic moves. Analysts at Commerzbank wrote that the extent of the correction suggests market participants were simply waiting for an opportunity to take profits after the rapid price rise. David Bahnsen, chief investment officer of the Bahnsen Group, said on CNBC that Warsh has the respect and credibility of the financial markets. There was no person who was going to get this job who was not going to be cutting rates in the short term. However, I believe longer term he will be a credible candidate. All of this happened, by the way, against a backdrop of other extraordinary news. While silver was crashing, Donald Trump was also in the headlines for filing a $10 billion lawsuit against his own Internal Revenue Service, claiming the agency failed to prevent a former contractor from leaking his tax returns to the media. The President of the United States is suing an agency within his own executive branch for $10 billion. If he wins, American taxpayers would foot the bill. Meanwhile, a massive American naval armada is sailing toward Iran. Trump has been threatening military strikes unless Tehran agrees to new nuclear negotiations. Iran's foreign minister said his country is ready for either negotiations or war. The USS Abraham Lincoln Carrier Strike Group has entered the Middle East region, bringing thousands of additional troops into an already volatile theater. And Congress was scrambling to finalize a deal to avoid a government shutdown, with funding for the Department of Homeland Security hanging by a thread amid controversy over immigration enforcement in Minnesota. Any of these stories would dominate a typical news cycle. Today, they were afterthoughts, overshadowed by the carnage in precious metals markets. So what happens next? The honest answer is that nobody knows with certainty. Anyone claiming to know exactly where gold and silver go from here is either lying or deluded. But there are arguments on both sides that deserve your attention. The bearish case holds that today marks a turning point, that prices had become grotesquely overheated, that gold at 5,500 and silver above 120 were levels disconnected from any fundamental valuation, that Warsh's nomination removed the fear premium that had been driving the rally, that metals will continue declining as the speculative froth is wrung out. The bullish case holds that nothing fundamental has changed. Central banks are still buying gold. China continues adding to its reserves. Geopolitical tensions remain severe, with American warships heading toward Iran and trade wars continuing. The dollar's long-term credibility questions have not been resolved by one nomination. The structural case for precious metals remains intact. The medium-term picture depends heavily on what happens at Kevin Warsh's confirmation hearing. He will face Senate Banking Committee scrutiny unlike anything a Fed nominee has experienced in decades. Democrats will press him relentlessly on whether he can resist pressure from Trump. Senator Elizabeth Warren, the highest ranking Democrat on the committee, has already called on her colleagues to block Warsh entirely, arguing that no nominee selected by this president can be trusted to act independently. Republicans will push him on whether he will cut rates as aggressively as the president demands. Warsh's answers will move markets. If he appears too accommodating to Trump, too willing to simply do whatever the White House wants, the fear trade could restart. Gold and silver could rally again. But if he convincingly demonstrates independence, if he signals that he will follow the data rather than the demands, then today's move could be confirmed as a genuine turning point. There is also uncertainty around the confirmation process itself. Senator Tom Tillis, a Republican on the Banking Committee, has said he will oppose any Fed nominee until the Justice Department drops its investigation of Powell. The confirmation path is not guaranteed. Every twist in the process could trigger more market volatility. And looming over everything is the question of Jerome Powell. Powell's term as Fed chair ends in May, but his term as a member of the Fed's Board of Governors runs until 2028. Traditionally, outgoing Fed chairs resign from the board entirely when their successor takes over. Powell has given no indication he will follow that tradition. Given everything he has endured, given the investigation, given the attacks, given the assault on the institution he leads, Powell might choose to stay. If he does, Warsh will be chair, but Powell will be in the room. Every rate decision, every policy statement, every press conference will carry echoes of the conflict that preceded it. This is not normal. None of this is normal. We have entered an era where a social media post from the president can erase hundreds of billions in value within hours, where the announcement of a single government appointment can trigger the worst day for an asset class in nearly half a century, where the line between politics and financial markets has been erased. Some will argue this is simply the new reality, and we must adapt. That may be true, but adaptation is not free. It demands constant attention to connections that seem unrelated but are not. The Federal Reserve, the White House, social media platforms, your retirement account, they are all linked now in ways that can manifest violently and without warning. Kevin Warsh will probably be confirmed. He will take over as Federal Reserve Chair in May. And from that moment forward, every word he speaks, every rate decision he makes, every signal he sends will be dissected for evidence of independence or submission. Markets will react. Fortunes will be made and lost. And millions of people who have never heard of Kevin Warsh will feel the consequences in their portfolios, their mortgage rates, their financial futures. That is the world we live in now. Today, we witnessed the largest single-day collapse in silver prices since the Hunt Brothers corner imploded in 1980. We watched hundreds of billions of dollars evaporate. We saw retirement accounts decimated. We saw mining stocks crater. We saw a market that had seemed invincible just 24 hours ago brought to its knees, all because a president announced a name. Tomorrow will bring something else. Another announcement, another tweet, another development in the Iran standoff, another turn in the shutdown negotiations. Another moment when financial markets react to political decisions that seemed abstract until they were not. The only certainty is that certainty itself has become a luxury we can no longer afford. Pay attention. This matters more than it ever has. Because what happened to silver today will happen to something else tomorrow. The asset might be different, the trigger might be different, but the pattern, sudden devastating moves triggered by political decisions that crash into portfolios without warning, that pattern is now permanent. Welcome to the new financial reality. It claimed silver today. Tomorrow, it could claim something you hold.